Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it's up. Now, we're in a wild moment in the financial markets. I'm going to load up the charts in just a moment. The stock market had the worst January in the Nasdaq ever, and then had a rebound towards the end of the month. Uh, in the first half of February that then fizzled out and we started to trade lower. Uh, and then last week, this news in Ukraine began to hit the news wires in the United States. And now this morning, a war has started there. And the markets have all gapped down substantially lower. But we're seeing, as I do this video at 11 a.m., a lot of buying, aggressive buying coming into the market. And I want to talk about that in this video, the short-term action and what I think is really going on and where I think the opportunities are to actually make money. And it's not in what people are doing today, which is buying the winners of the past couple of years, which now are not doing that great. And I don't think they're going to come back the way people think they are. But let me show you what's going on here in these markets. So, well, first of all, this is what people are doing today. Well, let's look at the average. This is how people see the market. They see that quote at the top. The price was down about more than that on the open. They experienced the daily price quote, what you see here. This is a screenshot taken at around 10 a.m. when the Nasdaq was down 148, the Dow down 679. And this is what people are doing that have Fidelity accounts. So what they show you is the top number of buys and sells. This isn't simply what people own, but people are doing in the markets at that moment. So, normally in corrections, they come to an end when there's a lot of fear in the market and people sell out on the bottom. Well, they didn't do that on the big gap down today. They did the exact opposite. People were rushing in to buy stocks. They bought Tesla by an almost 2-to-1 margin, Apple by similar margins, all these top stocks, NVIDIA, triple Qs, Microsoft, the spiders, all down the list, more buys than sells. And what that tells me is, now it doesn't really tell me anything about what the market might do over the next hour or even the next day, but we're in a correction that really, or decline, that began, whether it's a correction or the start of a bear market, I'll leave that to the side for a few minutes. But we're in a downdraft in the market that began around New Year's for the S&P, the Nasdaq, and the Dow. Now, it began before that for the Russell 2000. It began in February last year for things such as the ARK ETF, and most stocks actually topped out in around June and fell ahead of the stock market averages into bear markets of their own. But the averages themselves tipped over around New Year's because a lot of the big cap stocks such as Facebook, Amazon, Google, Apple, Microsoft performed better than the average stock. And then they were helping the performance averages, which is typically what happens at the end of a bull market. And then in January, some of these stocks got shot and hit. Netflix fell in one day 20%. Facebook also did the same thing. Facebook, after that drop, even fell lower and lower day after day. And that set the stage for what has happened this week with actually three attempted buys off the January lows. The first being in the futures market Tuesday night before the markets even open, and then two before today's big gap down, which is once again being aggressively bought by small traders, as you can see by the order flow at 10 a.m. by Fidelity. Now, I can't predict what is going to happen today. I'll just say that, I mean, there's two obvious scenarios. One, either this market rally continues, we go into the green, and then we can hold up, I believe, for a couple weeks, possibly, and then go lower, just like we have done recently with the January bounce, because I don't think this decline's over, because declines don't end when everyone is rushing in to buy, but when people panic. And people, frankly, are not panicking as much as I thought they would today. And there's a second possible scenario, and that's this rally fizzles out before the day's even over. And that has the risk of triggering margin calls, which would accelerate the decline and could lead to a more meaningful, I think, bottom tomorrow. Meaningful, though, I don't think, everyone in the markets trading actively now, most of them have only been doing it for 2 years. They haven't experienced a real bear market like what happened in 2000 or 2008. So they think things can just come back. And that's why they're obsessed with trying to buy these same old stocks. When in reality, when you have a bull market end, you tend to have leadership shift into new sectors that can actually do well in the bear cycle. And even when the next bull market comes, continue to go up, or new sectors go up. The past winners don't really do that. So in March 2000, when the market topped out, for example, Cisco was the big leader of the 90s bull market. But then after the March 2000 top, it lagged for a decade, and it took longer to make a new high than the Dow and the Nasdaq did. And that's going to be the story for many stocks, such as Facebook, Netflix, and so forth. And the ARK ETF is probably, I believe, doomed, just as the Janus fund was doomed. But people in the markets now don't even know what the Janus fund is. And I think what we're really entering is a mishmash of the bubble bust of technology stocks in the summer of 2000 and the inflationary 1970s, what was going on in the markets then with that. And I think the guidebook to, and I'll show you evidence in the charts of why we need to think about the 70s, is commodities did great, real estate did great, and you had rising interest rates in the 1970s and inflation, which is what we have now. And Ukraine and Russia is not the cause of that. It can be an accelerant in it, but we obviously had big inflation last year, and the Fed has to raise rates as a result, or inflation will be even worse. And that's frankly more important than what the shares of Facebook do. And I was listening to a podcast a few days ago in which it was mentioned that Dudley, the Fed official, said the Fed is going to raise rates till the S&P falls 30%. And they said another Fed official said the same thing. So, they're going to monitor the economic data and respond to that, and not the stock market moves, unless it really declines. And frankly, it's, inflation is more important in economic GDP growth and other statistics than the gyrations of these technology stocks, which are really bubble stocks because of the PEs. And many of them aren't even growth companies anymore when Facebook is not growing revenue. So this is the situation where we're at with the Nasdaq. I don't know what it's going to do today, but I have to, like everyone else, it's not really about predicting things. It's watching how things unfold and responding to that. So, if I wanted to trade this, frankly, I'd be sitting here waiting for a strong enough. At this point, I don't think there's anything to do by buying or selling. I would have to wait to see this rally enough at this point to have an entry point to short sell, because I don't want to short sell after you've already had a big decline and you gap down and the day's not over. I also don't think it's time to go long either. I don't really see a good trade right now at 11 o'clock. You have to be watching these markets, and I already got positions and things well ahead of today's action. So I'm not even trying to do anything. Just watch and talk with you about what I think is happening, where I think the real opportunities are. But first, let's talk about bigger term market cycles. And this is an article I wrote in February of 2017. And back then, the TLT ETF was peaking out. And I did an article Monday, which I'm going to link to, and you need to read if you missed it, because it puts more charts and explanations of how to make profit from this chaos seemingly that we're in. But what I talked about in here is key market cycle turning points, not short-term gyrations, but turning points that only come around once a decade. One of them came in the commodities market in 2020 when the oil futures went negative after the stock market March crash. And that was the end of a bear market in commodities that was going on for about a decade. And I bought the DBA ETF and I still hold it. I put about 14% of my money in it, and I haven't sold it because I don't think that wasn't simply representing a short-term gyration, but the start of a move that would last for years. And I believe even now is going to continue for years to come. I think this is a secular bull market in energy and commodities. I'm not telling you to buy that now because it's gone up so much. And, you know, I want, you know, before buying energy stocks at this point, I'd be looking for a dip or a pullback and, you know, to the 200-day moving average, which is how it works in a stage 2 bull market. The 200-day moving average tends to act support and tends to get hit about once a year. That's when you buy. At a stage 3 top, which the overall stock market went through last year, volatility starts to increase. Lots of stocks turn down. The moving averages flatten out, and then you break below them, which we saw happen in January. Then you have a failed rally in which things stall out, and now you're in a stage 4 bear market. That's the price action. I'm going to talk about the psychology shift in a second, but to return to key market turning points that are the moments to take trades, the greatest moments, the most optimal moments to put bets in. We saw that in commodities in 2020 and in interest rates when they made a peak, or the bonds peaked out, the value of bond funds peaked out and ended a bull market that really began around 1980, decades long, when interest rates were taken down to zero. And then in 2021, I was writing an article saying, you know, they peaked out. We're now in a secular turn, and the LQD and corporate bond ETFs started to fall, and they fell ahead of the stock market actually breaking down too, which is very significant. So we're in a bear market for bonds. Now, here's the other element of all this is the psychology. And when you have a huge bubble bull market, people start to think we got a new paradigm, and things are happening now that you've never seen before. So we heard this in 2020 and much of 2021. For example, Bitcoin was supposed to change the world and replace currencies in the dollar, and you know, it was a bubble, and it's come off its highs and it's down almost as more than anything else. It was a mythical story, but it was part of that new paradigm talk, which I heard in 2000. You know, the internet was going to change the world. Well, yeah, it did, but not the way they were claiming it would. You know, these internet stocks back then made no money, and they were saying they're going to just replace all these things, and most of these companies went bankrupt. They said the stock market wouldn't even decline because the internet was giving investors more information so they can make better decisions, and they had no reason to make big mistakes anymore. Well, that turned into be completely false. And then the other new paradigm is quantitative easing of 2020, and you know, they're just going to print money and the stock market can't decline because they won't let it decline. Well, then we dipped in January, and then you saw people such as Cathie Wood put out videos on the internet saying inflation isn't real and inflation's going to go away, because she knows that means that you know, interest rates will go up and it'll hurt these bubble stocks she's invested in. And on YouTube, people made other people made videos copying her. You could read comments from many people believing her talk because they were in complete denial of economic reality when they went to the grocery store, because they wanted to believe that the stocks would continue to go up. And now, as I'm talking, oil is up over $100. Oil was destined to go to $100 even without the Ukraine. But Ukraine situation today is an accelerant on underlying trends in the market. And the key to making money is lining yourself up with the underlying trends in the market, not daily gyrations, and identifying when these key long-term trends shift and change and taking advantage of that. Those are the key ways and moments where the optimal situations to trade are. It's not chasing trades. It's not jumping in on hype, or even buying penny stocks or playing options or these things that you've seen so many people talk about, SPACs. It's the key underlying shift changes in market shifts. Now, what's happened is in the February, the end of January to February bounce, where the market rallied back up to 208 moving average, that rally represented the return to normal move in this psychological cycle that matches with the price cycle. Now, we're not even at the fear moment yet, because people are rushing to buy today's open gap down. So we haven't even seen the fear element. And when I show you this psychological thing, I do want to tell you that the price does not have to go straight down, in some crazy crash as this chart represents. It can play out for a very long time. You could go down, like this instead of like this. And I frankly think it's more likely that the market kind of goes down at this kind of angle, drawn out over a year or two, then we're just going to just crash completely overnight. I don't really think that's going to happen. But what's more important is to understand this psychological, cycle in the bear market. And we haven't even seen a fear bottom. We'll get one, and then we'll get a rally, and then that rally will probably stall out, and we'll retest the lows or break new lows, and then you'll have capitulation. And the despair, what despair represents isn't necessarily massive losses in some complete crash, but people just giving up on the market as an investment. And then they just become disinterested and cash out to do something else. That's what happened in the commodity market. Commodities were red hot from like 2008, 2009 to 2011, 12. Remember, silver went nuts and peaked out. Many people were buying oil stocks, which peaked in 2014. And then those markets all went into the commodity complex as a whole went into a long drawn bear market. Didn't mean mega losses year by year, but the length of time of a decade made people lose complete interest. And that is how despair happens in a market. It's people just losing complete interest, liquidating their accounts and giving up, moving on to another market, or just getting out of trading completely. So where's the opportunity in this market? Well, flip back. So to the start of this cycle, takeoff. Well, we saw takeoff in commodities, really in it's happening now. This is takeoff, basically. Well, a lot of commodities took off last year. Gold and silver have now gone through 1900, which had been resistance for quite some time. And we're not even at the real media attention or enthusiasm phase, much less the greed or delusion phase. These are things that will play out over years. So we're still way early in the cycle. And this is one of the most important charts when identifying a sector, a commodity, an asset class to invest in. This is a ratio comparing the Commodity Research Bureau Index with the S&P 500, dividing the price of the CRB index with the S&P 500. As I said, this index just as commodities went in a bear market, this index went in a bear market from 2011 to 2020, 9 years. What that means is this ratio goes down when what you're comparing with the S&P 500 underperforms. So commodities were underperforming the S&P 500 for a decade, basically. Now, which is a stage 4 decline. It was going, the green and red lines moving averages were acting as resistance. Now, the stage 1 bottom was in 2020. And now we're in a stage 2 bull market for the performance of commodities versus the S&P 500. That means you can expect commodities to outperform the S&P 500 from now and the next several years. This is the start of a bull cycle, most likely a secular cycle. It could easily last a decade. Again, think of what's going on in the markets now, not as a short-term gyration, not as, oh, are we going to crash next week, or is this going to go up today? But think of it as a huge shift that's taken place in the past couple of months. It's sort of a combination, as I said before, of the summer stock market Nasdaq bubble top and the 1970s, a mishmash combination of the two. And think of that as a guide of how to navigate these markets in the years to come. And one thing that happened in the 1970s, bonds were in a bear market. Commodities, though, were in a bull market. So I think the key to making money now is going to be doing investments linked to these underlying trends of inflation and rising commodity markets. That doesn't mean there's not going to be pauses in rising commodities. And it is a difficult time to take new positions today when you've had, when their markets are more volatile, things will eventually calm down at some point. It's not an easy time to take positions for anybody. That's why, as I'm doing this video, I'm just watching, and I'll be curious to see how the day unfolds. But I just want to give you my 2 cents and thoughts for what we're witnessing today, and to keep our minds on the underlying trends, the big picture, the long-term trend changes, and not the daily gyrations, which everyone is focused on, and that's all you see when you load up a Robinhood app. Nothing that you can make good decisions with. Oh, so if you're new, hit the like button so YouTube will tell other people, hey, this video is good, and the algorithm will share it with them. And hit the subscribe button, and then hit the bell next to it, and then YouTube will send you a notification as soon as my next video is up for you to watch.